this year.
John, what's so important, I'm so glad you brought this up, and folks, there's no one you know that use Zoom less than me. Seriously, I'm really privileged that I don't have to do this garbage. But John, you really say to yourself, what's the future of this after the pandemic? And the market's voting. I mean, there's a lot of other Zooms out there where we've maybe really changed our behavior.
Before you turn your back on the growth debate, Lisa, maybe there's some juice left to squeeze. Zoom video speaking to that theme.
Yeah, well, the key is how much is this transformation of the economy really the issue versus actual growth, right? The tech preeminence that we're seeing in some of these names, that is perhaps separate from some of the other growth that we're looking for.
Waking up this morning with a bit of caution from China. Let's get to Ibrahim Rakbari, Citi Global Head of FX Analysis. Ibrahim, let's start with this question. Who leads the global cycle here? Is it the United States with all its stimulus or the prudent approach from China?
So we think there's clearly a bit of a handover going on, where China was essential and early in staging the global recovery. But right now, I think the weight is clearly shifting towards the US. And the types of growth numbers that we are expecting alongside many others in the US should give us some hope that even some slowing of momentum in China will allow the global recovery to power ahead pretty vigorously on the back of and on the shoulders of the US recovery.
Ibrahim, you're Edward Morse, the wonderful Edward Morse, published this morning on oil, reaffirming a range-bound area, and he's below the $80 hysteria we're seeing right now. I get the same temperament from you, an even keel to what you see in the foreign exchange market. Does your world now correlate with the rest of the markets, or is it separate and distinct?
So there are important linkages between broader markets and the economy and foreign exchange markets, but it has FX has also been playing to its own tune. So we have seen, in particular, dollar trends correlate with the global recovery. The dollar has, generally speaking, been on the back foot. But of late, for instance, we have seen that when US interest rates rose quite quickly, the dollar was effectively pretty range-bound in G10. And that's in part because interest rates rose elsewhere in the world almost as much as they did in the US. And because we have seen the behavior of investors focus more on equity markets and commodity markets as a primary expression of, let's call them reflation trades, than in foreign exchange.
Ibrahim, if the weight is shifting toward the United States and the strength in the U.S. has led people to go further into the dollar more than perhaps some expected at the end of 2020, can we see the dollar materially weaken from here with the U.S. also leading the global economic recovery?
Yes, that's a very good question, and one that we've dealt with intensively. And our answer is yes, it can, but we need two conditions to hold for that to play out. And condition number one, and most importantly, is we do need still a vigorous global recovery. So even if the US outperforms, but the global economy does okay, then the dollar can sell off just as it did after the previous two global recessions. And the second is we do need US real yields, and particularly US front-end real yields, to stay pretty low. And for that, it is important that we see a fairly forceful dovish message from the Fed on an ongoing basis. Even from
Do you expect that from Chairman Powell on Thursday, Ibrahim?
We expect a pretty nuanced message. So I think he will tread a fine line where he will reinforce his policy intentions, no consideration for tapering anytime soon, no intention to change hiking plans based on the recent developments, but equally that he will continue to endorse the good news and that the good news are expressed in bond yields as well. So it's going to be nuanced. It's not going to be a major pushback in our expectations.
Tom brought up the commodity market, so let's finish there, Ibrahim, and get to the commodity currencies in the FX market at the moment. Given what's happening in China, how comfortable are you with the conversation around another commodity super cycle, getting along the commodity currencies for that reason over a long time horizon?
So we think that the commodity currencies still have upside, and in G10, that's for us the Australian dollar, the Norwegian krona, Kiwi dollar, and CAD as well. We wouldn't talk of a super cycle per se, but we do think there'll be a vigorous demand for all kinds of commodities, for oil on the reopening story, for industrials on restocking and infrastructure, even with some slowing in Chinese demand. We won't have the super cycle like in the 2000s, but we think that bodes well for a further pickup in commodity prices after a bit of froth comes out in the last couple of weeks, and maybe that has a little bit further to run.
I'm amazed at how when the euro comes down, it comes down. Granted, it's within range. We had a little bit of a 119 print here earlier this morning. What is your 12-month call on euro? Is it tradable or is it a mystery?
So we still have upside in our euro-dollar forecast, and we think it'll peak out nearer to 130 sometime this year.
Wow.
That being said, in the short term, we think that the euro will lag, and that's for two reasons. One is because European rates have lagged and will lag global rates, and two, because the ECB has actually pushed back against the rise in rates more forcefully than, in particular, the Fed has. And it's a very opportune moment for the ECB because it can actually do something. It can buy more bonds. So it's a good moment for it to show to the market that it's not out of ammunition. So we think the euro goes lower first, but then higher against the dollar.
Ibrahim, great to see you, sir. Always good to catch up. Ibrahim Ragbari there, Citi Global Head of FX Analysis. Euro-dollar with a brief break of 120 in today's session. The low of today's session, 119.92. The euro, 120.21. Matt Miller, maybe with the stat of the last month when it comes to the ECB, the previous month, the month of February. Christine Lagarde, the ECB, Tom, has expanded the balance sheet more in about 15 months than Draghi did in 8 years.
I love that.
Just get your head around
really,
that.
Yeah, really quite good. That's great scope and scale, compare and contrast. John, what I see after the equity-a-thon that we had yesterday, besides it's wonderful to have David Costin joining us later, is the way it went up, the persistency, which goes back to Gina Martin-Adams at Bloomberg Intelligence, and this huge mystery of what we're going to see from corporations in America. And I don't want to give my opinion here, but just there's a massive what if when we get out to April on through August.
Hey, Tom, it was the everything of it. Lisa, it was IT up 3%. It was the financials up a similar amount. It was energy up 2.6%. It was everything and broad-based.
It was by the dip, very much in force. This idea that any sell-off whatsoever is an opportunity, and it's coming with this idea that we're going to get the fiscal stimulus, that we're getting better than expected data, and you've got earnings that have come in so much higher than expectations, not just the base earnings, but the forecasts going forward, Sean.
It is hard to be bearish,
There was no gloom
Lisa.
there.
It is hard to be bearish. You can you?
Yes.
Oh, please, give me a reason.
I think the big conundrum right now is how hot can the economy run in the short term before changing the longer term trajectory, either for the higher inflation outlook
There we go.
or
There's
for a
Elisa we
deflationary
love.
or a disinflationary outlook, because the Fed will be forced to hike, will be forced to act more aggressively without changing the underlying structure of the labor market. This, to me, is the conundrum that's baked into break-even rates that have gotten inverted, and we can talk about that a little bit more later.
Lisa, never change.
She's
Never
just
change.
great. It's
Being
just
a perma bear is like a free call option at no expiration. Don't you think you just got to cash it in whenever it happens? But in the meantime, you just keep
I'm
going.
not calling for the rally to crash.
We can go on through this hour.
I'm just saying,
continue.
looking around corners. There are corners to look around.
That's your line at the moment, isn't it?
To look around.
Peter Chair of Academy Securities. I have no idea what that was. Head of Macro Strategy joining us shortly. Looking forward to that. From New York City, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. The number of global coronavirus cases rose in the past week for the first time in almost 2 months. The World Health Organization says countries are easing restrictions, people are letting their guard down, and variants of the virus are spreading. Meanwhile, a variant detected in New York is being watched carefully. The Biden administration is set to impose sanctions on Russia over its treatment of opposition politician Alexei Navalny. Russian authorities have been widely blamed for the near-fatal poisoning of Navalny, and after he returned from treatment in Germany, he was put in jail. The sanctions could be imposed as early as today. A new study says that Dublin is the favorite location for finance firms moving jobs into the European Union after Brexit. According to the consultancy EY, 3 dozen financial services firms are considering moving some operations UK to the Irish capital, or have already done so. Luxembourg is second, followed by Frankfurt. And shares of Zoom are higher pre-market. The video meeting service projected annual revenue that would beat estimates. It's a sign that Zoom expects to remain a ubiquitous presence in daily life, even as the pandemic recedes. The company's stock jumped almost 5-fold last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The President and I are pushing the United States Congress to finish passing our American Rescue Plan, so cities have the resources they need to innovate and replicate the best ideas. This plan includes critical support for those communities that have been hardest hit, keeping small businesses open and first responders on the job.
The stimulus effort continues down in D.C. That was Vice President Kamala Harris speaking at the Bloomberg City Lab Summit. From New York City this morning, good morning. Alongside Tom Keene, Lisa Brambis, I'm Jonathan Ferro. Tuesday morning, here's your price action on the S&P 500. Shaping up as follows on the S&P. Futures down 14 with negative 0.4%. Tom Keene, yields higher by 3 basis points. Here's your yield, 1.4445%.
I'm glad to bring that up, John. I mean, if we're up 3 basis points, 1.44, maybe 1.45. I'm going to call it a constructive backup, John, after the festivities of yesterday, and we really just need to see how the markets take it. Will there be a bid on equities this morning?
Totally, and I agree with you, Tom. And will we get a bit of dispersion? Because what we saw yesterday was just buy everything.
Yeah.
Financials, IT, growth value, the loss, small, large.
Very quickly, the one thing that sticks out is you may get a 59 on West Texas Intermediate. That would be interesting right now. $60.58. Right now on to Washington as well. We heard from the Vice President and as she spoke to Bloomberg and to City Lab. Jack Fitzpatrick joins us now on the parliamentarian of the Senate and Vice President Harris. Jack Fitzpatrick, Nelson Rockefeller, 1975. He was the last vice president to tell the rule maker what to do in the Senate. Are we going to see that with the gentlelady from California?
It does not appear so. The progressives are citing examples like Rockefeller, and I believe Hubert Humphrey did the same at one point. But the moderates have decided they're going to stick with the parliamentarians' ruling on what counts as a budgetary bill that you can pass and get around the filibuster. So really the key person there is Joe Manchin, who has said absolutely not. I'm not overruling her.
I studied a careful Pew Research article on liberals from about a year ago showing the size of liberals within the Democrats, the size of liberals within and across America as well. What is the power of progressives right now? Is it there or is it a fiction?
Well, it's significant as part of the party. They aren't the key pivotal people that Joe Manchin and Kyrsten Sinema might be. But, we're already hearing them try to affect what's going to be in this next package when you hear about Elizabeth Warren's wealth tax that may not actually become law, but sort of sets a marker for what Democrats could talk about for this next big bill when they get into tax discussions. They can pull the party left even if they are not the swing votes in the Senate.
Jack, what's Chuck Schumer's biggest challenge this week?
just not making a massive mistake. It's always a challenge to keep 50 out of your 50 members in line and rely on the vice president to cast that tying vote. It got easier for him when they pulled out the minimum wage provision that was turning off Manchin and potentially some others. So it's not an uphill battle, but he's got to have 100% success rate in order just to whip the votes and keep everybody in line.
Based on the fact that the bill is pretty much in form, as you lay out, given the fact that that one provision was taken out, are we still talking about $1.9 trillion? Are we still talking about the same, I believe, $350 billion for state and local governments?
Yeah, the top lines are all effectively the same as what Biden proposed. That minimum wage thing is the only major change. We'll see some minor tweaks over the next couple days. So the Senate will vote and the House will have to vote on an amended version. But this is basically the same thing that Biden proposed.
Do any Republican senators want this, Jack?
Not that we've heard from. Those conversations have kind of fallen off the wayside. And when we heard what the president will focus on, it sounds like he's going to be talking a lot more to Democrats just to sort of circle the wagons and make sure it's 50 out of 50 Democrats.
Let's recap the process a little bit then, Jack. Was there ever any negotiation across the aisle? Was there ever any real intent to compromise here?
Democrats seem to have viewed that as a potential bonus if it had happened. This is something they knew they could largely pass through reconciliation with their own simple majority. They talked to Republicans. The president met with them. Does that mean it's real negotiation? I mean, the proof is in the pudding that this is essentially what Biden proposed. There were almost no changes. So this was not a bipartisan process, obviously.
Jack, I want to shift gears a little bit to just sort of wrap up with what's happening in New York State. Andrew Cuomo, governor, coming under a lot of heat for some allegations of sexual harassment of his aides. I believe 3 have come out now and accused him. There are calls for him to resign. How significant is that? I mean, have you heard that seems like a realistic possibility in the next couple of months?
That obviously is significant. That's worked into the Washington discourse, but so much focus has been on this bill, and at least among Democrats who you'd look to see if any allies push back. You know, there have been so many other things that Washington has been focused on. Right now, that's more of a line that Republicans are hammering Cuomo on. He's really the boogeyman for Republicans, but I don't think there have been developments in Washington that necessarily change the state of play in Albany just yet.
We'll return to DC for more on that a little bit later. Jack, appreciate your time this morning. Thank you. Jack Fitzpatrick there of Bloomberg Government. Thank you. After a huge 24 hours in this market, the equity market in the United States absolutely flying. This morning, a little bit of a pullback on the S&P 500, down around about 0.4%. The euro, a brief break of 120. 120.27 is where we are at the moment. And yields are higher by about 3 basis points. Though I have to say, the news comes out of China. Just a bit of pushback from the Chinese regulator, Tom, around financial stability, and I think that's important.
You see that with renminbi weaker, 6.47 versus 6.45. ADXY pulls back as well. John, I do want to point out something very quietly. It's the 28 flavors of the bond market, and it is the vanilla spread. The 2s10 spread continues to advance, settling in right now at 1.32% difference between the 10-year and the 2-year. Move the decimal point 2 places, 132 basis points. It's acting very normal, John.
And Lisa,
when it goes, it goes.
Wider by another couple of basis points this morning.
Here's what I'm struggling with. And I was talking about this earlier. Long-term inflation expectations are coming down. Short-term inflation expectations are skyrocketing to the highest since 2011. How does this match with a yield curve that's widening, that's steepening? How does this match with expectations that we're going to have an orderly transition? Yes, a boom in the short term, but then a steady inflation environment over the long term. I'm trying to pair these things and get some sort of sense, and there's still a lot of questions to me, John.
Because I guess the move of the last couple of weeks, Lisa, has been driven by reals and not by inflation expectations. Didn't that just tell the story?
Well, that means that the Fed isn't going to be as involved in buying the longer-term debt, and this is a supply issue, and this is a growth issue. But the question is, you know, how sustainable is that? I don't know. I mean, these are all questions, I think, that are baked into the markets right now.
I think they are the Fed's forecasts, aren't they? Base effects kick in, inflation shoots higher. then it fades.
Yeah, well, that's their expectation. Then you've got people like Larry Summers coming out and saying they expect longer-term inflation to pick up more than previously expected. Tom, I mean, honestly, weigh in here, but to me, it seems like this is a conundrum. At this point, everyone's just accepting the idea of a low-inflation environment for the longer term with some questioning.
There's no question about it. I would suggest the former Secretary of Treasury, the gentleman from Harvard, he's looking around corners. I mean, that's what you've got to do here, John. You've got to, you've got to, within the joy out there and 6% GDP, you need to be looking around corners.
That's what we're all trying to do.
We're looking around corners.
There are corners, apparently.
And you can look around them.
Tom Keene, I'm Jonathan Ferro. Going to restart the show in the following segment.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV. Here's the price action. We pull back after a monster day of gains. The S&P 500 up the most since last June 2020. This morning, we pulled back about 1/3 of 1% on the NASDAQ, down by 1/3 on the Russell, off by 0.7 of 1%. What a rally yesterday. The financials, IT, energy up 29% year to date. Just got through 2 months of 2021, and we're already up 29% on S&P 500 energy names. Switch up the board in the bond market. Here's the question of this morning. Who leads the global cycle? The United States or China? In the United States, the curve is steeper, yields are higher, up 3 basis points on 10s, up 4 on 30s. The spread between 2s and the long end just getting a little bit wider, higher, longer, steeper. Why? Because people expect better growth in the United States. Why? Because the vaccination rollout has been fantastic. Why? Because we're about to throw $1.9 trillion at it. That's why. Let's switch up the board and get to this. So that's the outlook for the United States. Here is the outlook for China. For China credit watchers, they'll be familiar with this. This is the China Credit Impulse. It's new credit as a percentage of GDP. Gives you an idea of how things are going in China, how tight things are, how loose things are. Look at the end there. Things just starting to tighten up over the last couple of months. Nordea, over the weekend, raising, I think, a really important question. How is it possible the commodity market is still rallying as that is happening?
Yeah, and John,
and that, for me, Tom, is something to keep an eye on.
This is a really, keep that chart up if you would. Go back to that chart if you would. And what you need to understand is Beijing is really, really, really comfortable with a greater austerity. And John, they are massively constrained. They are massively constrained in doing that by the domestic politics. They got to keep the spigots going.
So look at the regulator this morning, Tom. Comes out and says, you know, we're not happy with some of the financial stability risks out there at the moment. You've seen what's happening with credit over in China over the last couple of months, and yet look at copper this morning. Copper's still doing okay. Crude's still doing okay. Is this market really correcting to what is happening in China?
I don't see a correction. Very important.
It raises a really important question for this year, Tom. If that's going to be the story in China, an emphasis on stability as the United States just rockets through 2021, who's leading the global cycle, and what does that mean for the global trade?
And you certainly saw it in the research note of the morning. Ed Moore's publishing at Citigroup on stability within the oil market as well. Let's get some stability on the American economy. Sarah House with us with Wells Fargo and their senior economist. And Sarah, I have a Target just out with comp sales coming in higher than all the geniuses thought, looking for a huge 18% statistic that come in at 21% rounded up. You say we're flush with cash. John just mentioned that with the stimulus, and you're going to migrate from 6.2% higher. How much up are you going to lift? I mean, are you framing 6 to 7% GDP, or are we going to shift from 6% to China-like GDP?
Well, we're looking for 6% GDP this year, and a massive pickup really comes second and third quarter, led by the consumer with all this fiscal stimulus flowing through and the excess savings beginning to get spent. I think when we look ahead in terms of where the risks of that forecast lie, potentially they could be to the upside, just given, again, how much excess saving there is, and that has the potential to even get spent further into 2021 and really still propel growth quite strongly in 2022. This is more than just a summer reopening story.
Well, what's so important here is the idea of 6% and beyond. I mean, you are going through those calculations, as is every other house right now. Are those calculations out 0.1%, or are they out big figures?
So we're looking at in terms of the overall the spending picture. I mean, I think you can see some pretty big figures just when you look at what's driving this. You know, so we've seen big figures in terms of case count declines recently. We're seeing, in some ways, I think the relief package that's working its way through Congress now is even bigger than Democrats maybe expected they would get. And so I think you are still looking at some pretty substantial numbers when we look at the outlook for not just the middle of this year, but on into the latter end.
When you talk about spending, it kind of speaks to John's point. Who leads the next end of the cycle? The idea of, you know, if we don't have China leading the dynamism in global growth, can an infrastructure spending plan in the United States, can more spending to make energy more green throughout the world end up supercharging some kind of cycle in commodities and global growth that perhaps is not driven from China?
It can certainly help. I don't know if you can get a full another commodity super cycle. I think in many ways the bounce we've seen is driven so much by this pickup in demand. But when we look at just what's happening with just real disposable income in the household sector, and even when you layer on top of that a possible infrastructure deal, these are one-time boosts. And so whether we're going to continue to see that pickup in spending, I think is a harder question. And so that could impede really the durability of that commodities boost. But I mean, right now it's certainly filtering through into some of the inflation numbers and pointing to a sharp pickup there.
Okay, so a one-time boost. Let's say that the infrastructure spending or the fiscal stimulus that we get passed on March 15th, as the Democrats expect, is a one-time affair. Does that lead to longer-term inflation that's higher than people are currently pricing in?
So I think we will see inflation settle at a notably faster pace than what we saw over the last cycle. So we'll get a pop here in the second quarter, but when we look out further, we're looking for core PCE inflation to run a little over 2%, so maybe roughly 2.25% over the next year and a half or so. So I think that is a meaningful lift, particularly when you just think of how much the Fed has struggled with inflation over the past decade. But it remains to be seen if it stays persistently high. And I think to look at that, you're going to need to focus heavily on inflation expectations. So does this become self-reinforcing? Have you actually broken that mentality of low inflation that has been so pervasive over the past decade, where businesses feel like they can actually pass higher costs on to consumers?
Prices paid, 86. I'm talking about the ISM in the last 24 hours, Sarah, and it was phenomenal. A 60 handle on manufacturing. That's what we want to see. Then you get into prices paid, and this has been a trend for a while now. People were looking for 80. We got 86. Can you just frame that for us? How important that is and what explains it?
Well, I think it's hugely important, especially when you consider that the last time it was that high was back in 2008, when you did have a big uptick in commodities, but at the same time, demand was absolutely tanking. Here, this is a very different scenario. So you actually have demand ramping up markedly. And so it does suggest that, again, we are perhaps shifting into a higher inflation environment. Now, of course, most of that comes on the good side when we look at inflation in its entirety. Goods only account for roughly a third of consumer spending, so we need to keep a close eye on what's happening in services. But basically, we've taken away a major source of disinflationary pressure over the past decade, and that was really evident in yesterday's ISM prices paid component.
So, Sarah, for you, this is a demand story. It's not a supply side story, supply constraints, all those kind of things.
It's actually both. So I think immediately we're certainly still seeing some supply constraints. I mean, you mentioned the prices paid index, but look at what happened with the supplier delivery. So that remains elevated, not quite as high as what we saw in the midst of the lockdowns, but still substantially elevated as we have issues with transportation networks, issues with manufacturers getting their staff in with COVID and keeping those assembly lines running it to the full extent. And so it's a little bit of both. So we expect those supply disruptions to ease, at least when it comes to some of the labor challenges over the year. But I think you're still going to have some bottlenecks, just given how strong the goods and orders picture have been in recent months. It's going to take some time for those backlogs to get filled.
Sarah, not to put numbers in your mouth, but if we move from 6.2% to 7%, or dare I say 90 days of 8% GDP, how does that change the I part of the equation? Do you guys have any understanding coast to coast of how corporations will invest in this boom? Or do they just do what they've always done, which is buy back shares?
Well, I think it's certainly supportive for the investment environment when, again, you talk about some of these supply constraints, not just from the staffing issue.
But do you see evidence of it? Is there evidence that they will invest?
Well, we've already seen very strong investment, and it's maintained stronger. So instead of hitting, perhaps an air pocket as we had investment pulled forward for things like information processing equipment, it's remained incredibly strong. We saw it with the durable goods report last week, the core shipments up 3.5%. And so it seems like you are getting continued momentum where businesses are rising to meet that challenge and meet that demand, and that's supportive of investment.
Hello guys, I'm planning to sell Bitcoin. So if you're up to a Bitcoin, if you're not a mad investor, but just want to buy Bitcoin, I'm looking to sell at 49,200. This is the price I'm looking to sell. So I'm going to wait until it will reach this level. And I want to sell it. So if you're looking to sell Bitcoin, like I said, in this case, we're not calculating our profit in pips. We'll calculate within the percentage wise, because the price range very different compared to other pairs. So please make sure, let me all point out where I'm planning to sell, that there won't be any misunderstanding when we'll sell within the profit, and it won't be probably as big as pips-wise destination, okay? So we're going to calculate 0.1%, 0.2%, 0.5%, like this. All right? So order placed, and let's wait for price to reach this level. For anybody who wants to get the strategy, please do so from our website, or you can get from the red line on our site. You will get to our webinar. Webinar includes strategy, so you can purchase it. Okay, I'll speak to you later, guys, when we will get into this trade.
Momentum it lost to severe weather last month. It posted 3 consecutive days of 2 million shots or more since Friday. Authorities are expecting another immunization surge in the coming weeks. The recently authorized Johnson & Johnson vaccine is being added to the mix. President Biden's choice to head the Securities and Exchange Commission, Gary Gensler, goes before a Senate committee today, and some might say the timing is perfect. Stock market drama has many calling for more regulation of Wall Street. Gensler has experience as a markets regulator during the financial crisis. He was a chairman of the Commodities Futures Trading Commission during the Obama administration. New York Governor Andrew Cuomo is facing more calls from fellow Democrats to resign. A third woman has come forward to accuse him of inappropriate behavior. The governor is already facing investigations into whether his administration covered up the number of coronavirus deaths in nursing homes. And in China, President Xi Jinping wants to mobilize the country for a tech revolution to reduce its dependence on the West. At the annual meeting of China's legislature, Communist Party leaders will approve a 5-year policy blueprint. It's aimed at cutting China's reliance on other countries for components such as computer chips. Meanwhile, Beijing will make big bets on technologies such as hydrogen vehicles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible. So that question can't even be answered until June. But I do think you may see some companies do it. I mean, I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure. And I would say carrots and sticks, not mandatory.
Jamie Dimon there, JP Morgan chairman and CEO, in an exclusive conversation with Bloomberg TV and radio in the last 24 hours. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. Here's the price action. We pull back after a big day of gains on the S&P, the biggest one day of gains we've had since June of last year. Equity futures come at 11, call it 12. We're down a third of 1%. Yields are higher, the curve is steeper. Your yield on a 10-year maturity, 144.28. Tom, I know you're focused on the commodity market. Crude just about hanging in there. We come down a tenth. WTI, $60 and about 60 cents.
It's maybe the most obvious thing that's given away, but we're watching others. And as you mentioned, John, Euro, I'm watching that for a 119 handle. We're not there yet. Earlier, just for a cup of coffee. He needs a cup of coffee because what we do is we talk to pros in this horrific pandemic who are doing, not talking. Amish Adalja has spent the evening in ICU at his hospital, and he joins us now after a long shift. How is ICU different, Dr. Adalja, now versus 10 months ago?
It's right now, it's about the lowest that I've seen with COVID in several months. I think 10 months ago, we were looking at, it was actually the middle of kind of the summer surge. Around that time, we're starting to see the spring surge, kind of a lot more patients, a lot more nursing home patients getting infected, a lot of them showing up in the ICUs. Right now, I would say there was only one coronavirus patient in an ICU, which is a good change. Mm-hmm. I think the height of it here, I clinically work in Pittsburgh, although I have a Hopkins affiliation, was around the winter time when it was really inundated during that winter surge. And that seems to have dissipated. And I think that's evidence that our vaccine is getting to those vulnerable populations and they're getting protected. And we've seen it in the national data when you look at nursing home deaths, nursing home cases. And I think that's going to give our hospitals a lot of respite in terms of capacity concern, which gives governors flexibility.
The nursing home success is the 80-year-old cohort. Maybe maybe the 70-year-old cohort. What is your timeline to get down to the 60-year-olds and to begin to benefit those 49 and older?
It's likely going to be different depending upon the state. So there are some states that are already moving into high-risk individuals that are less than the age of 65. In my state of Pennsylvania, they haven't done that yet. They're still really sticking to the 65 and up cohort. So it's going to take some time. It all depends on vaccine supply. The Johnson & Johnson approval is going to help, but in the short term, we're only getting about 4 million doses. So it's going to take some time to trickle out, but we are getting better. We are moving faster. So I do think that as we get into spring, mid-spring, we will have most of our people that are at high risk that live in the community vaccinated or have access to the vaccine. And I think even before we cross that herd immunity threshold, we'll be in a very different place because we won't be worrying about hospital capacity or personal protective equipment or ventilators or any of that anymore. And I think that's really what drove a lot of the public health intervention, because we were always worried about keeping the curve below hospital capacity.
Dr. Adelja, how concerned are you about the New York variant?
It's hard to know exactly how to be concerned about all of these variants. There are many of them that are kind of floating around, and there's many that we don't even have characterized because we don't do much sequencing. I think the New York variant is something kind of in the intermediate range, that we worry about it being more contagious. Our vaccines are likely to still prevent what matters when it comes to these variants or any of the original version of the virus: serious disease, hospitalization, and death. So I think the existence of these variants just underscores the need to accelerate vaccination to the fastest pace possible.
Are we winning the race?
I think we're kind of keeping pace with it, but we'll see what happens to the overall number of cases right now. They had in the last 10 days or so, there's been an increase of a couple percent. We don't know if that's actually a trend or if that's an aberration in the data. But as long as our cases are flat or going down, I think we're at least treading water, and nothing serious is going to it's not going to undercut that. But if we go up again, if we see, for example, the UK variant continue to increase, then I think we really need to step on the gas when it comes to vaccination. And I think we're getting better. Over 2 million is getting better. I think there should be no speed limit, however, when we're talking about vaccines.
Is the trend in better data on hospitalizations and deaths linked somehow to quarantine? Or do you just simply have to wait way down the road to begin to ebb quarantines country to country?
I think you're going to have to do a lot to disentangle what goes on. And we know that social interaction spreads the virus. So the less social interaction you have, the less likely you are to have cases. But what does each added step do? That takes a while to control for, because people will voluntarily start to quarantine. People start wearing face coverings at the same time. People start to wash their hands a lot. Mass gatherings get canceled. All of that has a role. So you have to kind of piece apart things and try and control for all the different variables that were happening at the same time to know exactly what each public health intervention has. And it's a hard job to know exactly what worked.
Dr. Adelja, how much of a stumbling block is it that children cannot get vaccinated and probably won't be able to get vaccinated until potentially early next year?
I don't think it's really a stumbling block if you look at the epidemiology. We know that children are usually and greatly spared from the severe consequences of disease. There are some exceptions, but in general, they're not at high risk, and they're not accelerators of the virus in the community. So with influenza, they really drive a community's transmission of influenza. They don't do this with coronavirus. So what we were trying to do with the vaccine is reduce the harm that the virus was causing, and that meant going after the vulnerable populations first. So I don't think it's an obstacle. And remember, there's a different risk-benefit calculation when you're talking about vaccinating a 9-year-old versus a 90-year-old. And you have to really think, is the vaccine, this vaccine or these current vaccines, the best vaccine for this child? Or will it be some second-generation vaccine down the road that might have a less of a side effect profile? So I think we need to do the studies. I think children will get vaccinated, but I don't think it's an obstacle to anything right now.
Doctor, I know you're at the end of your overnight shift, so we'll let you run. Thank you for your hard work, sir. We appreciate it. Thank you. Hamish Adelja there of Johns Hopkins. And just to bring you the latest numbers in the United States of America, your daily average now in the past week, Tom, 1.82 million doses per day.
The numbers, John, I mean, I'm looking at them, and I know you're looking at them, and Lisa's looking at them differently, each in our own way. The numbers are just spectacular, and I think you're right. The difference, John, of 1.6 million doses out to 1.8 is ginormous. It's not a linear function. It's a statement on a nation. I'm looking at those bar charts, John, and the 74 million vaccinations they've done in the United States. You sum up everybody else, and they combine to be less than America.
Unreal. Things are better in ICU. in the United States of America,
Yeah.
Tom. The degree to which the vaccinations help prevent severe cases is tremendous. And I think a lot of people who come on this program, including the relationship we have with Johns Hopkins, really underlining the fact that we might be starting to see that in the data already.
But we got to see it over to Europe, John. I'm sorry. You're
tell you,
better at
I
this
agree.
than I am.
I agree.
Europe is just what's the why there, John?
Tom, it's not just about supply anymore. You know, the governments across Europe have really damaged the reputation of the AstraZeneca vaccine by some of the commentary of the last several months, and they've now got to work on acceptance. So it's not just supply, it's acceptance as well. The two problems you don't want anywhere right
it's
now.
It's unfolding. I mean, for our U.S. audience, this is really fluid. It's unfolding in Europe, not in a good way.
Coming up, Peter Cheer, Academy Securities Head of Macro Strategy from New York City this morning. Good morning. Alongside Tom Keene, Lisa Brammitz, I'm Jonathan Ferro. Futures lower from New York. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
need rates to keep rising, but we need to do it in a slower, more orderly fashion.
The Fed really haven't pushed back in any real shape or form against those higher rates.
When things are really ripping from a growth or an inflation perspective, you can't say things don't look good.
The reopening is not even in the market yet. This value trade is still relatively new.
There's plenty of scope for more fiscal stimulus, and it looks like we are going to get it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Seemingly everybody getting bulled up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. With equity futures down 11 on the S&P, we're negative 1/3 of 1%. Tom, increasingly, I just feel like we're going to have this conversation around U.S. exceptionalism for a while now.
Well, it's very lonely. It's the success of the United States and all of it about the medicine, as we heard from Dr. Adalji of Johns Hopkins a moment ago. My major message, John, right now is in the last hour, the improvement in the tape. When we opened at 6 o'clock, it was grim, and it's just simply gotten better here as we try to digest that huge 600 Dow point move yesterday.
As the session grows older, I'll push aside your Dow point move from yesterday.
It was 603 Dow point move, I believe.
Big session, though, on the S&P 500.
And Russell 2000 moving as well. They all moved.
Euro dollar with a break of 120. Briefly, Tom, a 119 handle just for a moment. And the compare and contrast between the United States and the rest of the world right now is fascinating. Europe's struggling to roll out this vaccine. Really bad news there. And not just about the supply. It's now about the acceptance of the AstraZeneca vaccine in the population. Away from that in China, pushback from the regulator about bubbles. And then you've got the United States just pedal to the metal.
And again, I'm going to go range bound. I mean, to me, it was hugely, John, range bound overnight. Ed Morse publishing new ranges on oil, maybe $40, $50, maybe $60 a barrel. But is a range a bad idea? I don't think ranges are a bad idea right now.
Elisa, things are getting better.
Yeah, and there's been a theme where generally when you have a global resurgence, you have a weaker dollar. This time, will it be different? Can we have this ongoing strength in risk assets with a strengthening dollar based on that exceptionalism that you're talking about? And Ibrahim Rahbari was saying, not necessarily, the dollar can still weaken, but people are going into the U.S. because of that strength that they're seeing that you're talking about.
Yeah, came into this year and everyone was talking about global synchronized growth, Tom, and the high beta plays to that. EM, European cyclicals, mid caps, small caps, in international. And Tom, I sit here now and I just don't see it.
Well,
really struggle to see it.
The institutional play, that's a really good point, John. The institutional play may be there clearly on small cap and clearly on international. Maybe we'll see that, maybe we won't. But the distinction here is the medicine. The greatest disparity on March 2nd are the medical stories out of the United States versus the medical stories, you name the cities, John, Paris, Jakarta, Berlin, on and on.
Couldn't agree more. Here's your price action this Tuesday morning. Good morning to you all. The equity market looks a little something like this on the S&P 500. Put it back 10 points and down 1/4%. In the bond market, yields are higher. The curve is steeper. Your yield on a 10-year maturity, 1.4445%. Yields are higher, Lisa, by about 3 basis points.
Yeah, the yields are higher and people are looking to that growth, to some sort of action in Washington, D.C. Also today, we are going to be hearing from Gary Gensler. He's going to be presenting in front of the Senate Banking Committee to potentially become the SEC chair. Very interested to hear what he has to say about the GameStops of the world, the Robinhood trading, and the froth that you're talking about and that we've seen people talk about with the ARK Investments and Kathy Wood. Then also today, the Fed Speak continues this drum roll of speaking before the Thursday Fed Chair Jay Powell's presentation. Today, we've got Lael Brainerd and Mary Daly both speaking. I'm very interested in what they have to say about some of the turmoil in the bond market. Lael Brainerd actually had some interesting things yesterday to talk about possibly some sort of ongoing repo operation to calm some of the liquidity concerns in the Treasury market. And then at 1 p.m., Joe Biden will participate in a virtual lunch with Senate Democrats. This comes, of course, as the Democrats try to get that $1.9 trillion stimulus bill passed by March 15th, John.
Lisa, thank you. Let's turn to our guest this morning, Peter Cheer, Academy Securities Head of Macro Strategy. Peter, I remember about 10 months ago getting a message from you about how constructive you were about the outlook. And at the time, there was almost some negative connotations attached to being optimistic because everything around us was so negative. It was uncomfortable to be long, you were long. Looking forward from here, you're still long and constructive. Why, Pete?
I am, but it's more reduced down to what's going to benefit from infrastructure spending, what's going to benefit from resumption of travel, And at the other end of the spectrum, there is froth in parts of the market. So I am pulling back from those, really kind of actually nervous that we could see a significant pullback in some of the frothy end. So it's a little bit more of a mixed bag when looking at my portfolio. And I've also been really pulling out of Europe and the rest of the world. I think they're just not getting it.
Peter, define catharsis here. The 2-year yield last Thursday in this crisis was a 5.1 standard deviation move. I mean, clearly that's catharsis. But is that so isolated it doesn't matter? Do you see that emotion that means a trend change?
I think people got it wrong. It definitely was concerning to me where we saw in yields. But I do believe that this Fed is extremely committed to not hiking, that they are going to try and drive the unemployment down to sub 3%, that they want everyone back to work. And so using the calculus of what the Fed used to behave like is going to lead to wrong decisions at the front end of the yield curve. So look for them to really stay committed to no hikes, and that's going to keep that front end anchored, keeps the back end a little bit stable. So I think that's going to be good for growth, but we've got to be cautious on that.
So let's go to where you do think that there's going to be some catharsis. You said that there could be a significant pullback in frothy areas. Talk to us about what that looks like.
Well, I think, for lack of a better word, somewhat it's those archetype stocks that you mentioned earlier. There's been an accumulation of, stocks. It's becoming very concentrated who owns them. There's a positive story, but the inflows have been supporting it. And you've seen a couple times last week where you get these little cracks, and when you get outflows with the selling pressure, the move is very, very dramatic. So it's a very small subset of the market, but it's been an important part of some of the indices.
You said something really important, Pete. They're just not getting it. You look into the rest of the world, they're just not getting it. Do you think other investors are, quote, getting it? When you look at what's happening in Europe right now, when you look at what's happening in China at the moment, and then you look at the commodity market at things like copper, it's hard to reconcile a lot of things going on in this market with what's going on the ground in these respective countries.
Yeah, I'm increasingly worried about Europe not getting it, and also emerging markets, right? Emerging markets have benefited greatly from this run on commodity, but they seem to be really struggling with how to deal with COVID, how to get past it. So I do see the separation between the U.S. and I see ongoing friction between the U.S. and China. And I think that's really going to impact both Europe and emerging markets. So I'm nervous on where those are in terms of valuations.
Does that shape what you are long in the United States?
Definitely. Within the U.S., I completely think we are going to get infrastructure spending. It's going to be unique infrastructure spending. I think we're going to actually get 5G built out in the inner cities. I think we're going to do some interesting things that let that infrastructure spending really be dramatic. I think we actually see an infrastructure bank that will allow the spending to be more focused than if just Congress does the appropriations. So I'm excited for that. And anything that's kind of, bridge and tunnel building should be good as well.
Peter, you channel the Beverly Hillbillies in your research note. I know Jed Clampett got lucky with a gun and up came a bubbling crude. Explain to us the Bubblish now and the Beverly Hillbillies.
So what I want to talk about there was a fund that really resonated with me back in 2007, 2008. It was a commodity fund. It bought a lot of high yield equities. So, and those equities had relatively small floats. As money kept coming in, as commodities kept rising, that fund did very, very well. There was a big bearish sentiment. People kept getting squeezed and it kept going higher and higher. And then something turned. And when it turned, it went very, very quickly. And that's what concerns me about some of these archetype investments, that you've seen this very similar sort of pattern, and that's where I see that froth.
I mean, Lisa, it basically comes into hydrocarbons within the high yield space.
Well, there definitely is concern, and something that Peter was talking about, this idea of the concentration in the names, and actually ARK Investments has about 10% concentration on, I believe, 29 companies. Peter, aside from just small bubbles that burst, is there a way to play this, whether it's shorting, whether it's using some sort of instrument or staying away from certain indexes?
I've been staying a little bit away from the NASDAQ 100. It's more concentrated. There's more exposure there. I've liked the Russell. I've liked really sub-indices. I like XBT, XLE, things that are going to benefit from this infrastructure spending, the things that have lagged. I almost start with a chart that anything that's not 5% above where it was January last year deserves a second look. Anything that's, 50% above where it was January last year probably deserves a second look the other direction.
Just real quick, Peter, I know that you have an expertise in credit, and I do want to get your view on what we've seen with respect to the rise in interest rates. And I'm wondering, from your perspective, at what point, with Treasury yields rising, is it a concern for you with creditworthiness, with the idea of how easy it is for some of these companies to borrow?
I'm actually not worried about it. In fact, I think this is going to be very healthy for the credit markets. I think really last year what we saw was companies issue a lot of debt. I think they got ahead of this. They issued as much long-dated debt as they possibly could get away with because of those low yields. So one, they've locked in debt, so you don't have a lot of roll-off. And I think companies in general are going to be comfortable having debt roll off because they overissued last year. So I think companies actually did a very good job of capturing low yields. So I think we're going to see a dramatic drop off in investment grade and high yield new issuance, especially in the investment grade. And that's going to be very supportive for the credit markets. If we get a sense that companies do need to borrow, I'd get a bit concerned, but I think they actually did a very, very good job last year in terms of managing their balance sheet.
We've had some monster supply, some monster issuance over the last 12 months. Pete, good to see you, sir. As always, Peter Cheer there, Academy Securities Head of Macro Strategy. Tom Keene, things improving on the morning just a little bit. We're down 0.2 now, off by 7 points on the S&P.
The tape's definitely got a bid to it. You watch it, you see it confirmed in the yield space. You've got the 30-year bond out 2.23%. John, Megan Fitzgerald just channeled John Farrow. She's a professor over at Columbia Health, and she shows a chart of Europe, which is basically the United Kingdom, Turkey, maybe Germany, getting the vaccination story done, and everybody else just a colossal failure. I think so many of our viewers and listeners don't understand the massive failure in Europe and what that means for the financial system.
They started later and the gap's not closing. I think that's the problem. So you take France right now, 2.4% fully vaccinated, 4.6% of the population, one shot. The UK, you compare that to the UK, who have focused on one shot, one dose. 30.4% of the population has had at least one shot in the UK right now. And the United States numbers are great too. 15.3% one shot, almost 8% fully vaccinated. The compare and contrast, Tom, it's pretty clear.
And you see it again within this idea. I mean, let's go back to Bill Gross years ago, John. It was about a locomotive, whoever the locomotive was, and the assumption the cars were behind it. Are there any cars behind the locomotive?
I remember coming out of the crisis last time around, Tom, and the one thing we talked about continuously was decoupling. With the US decoupled from what was happening in Europe, and Europe is not looking good coming out of another crisis once again. From New York City this morning, good morning, alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Futures are negative, we're down 7 on the S&P, we're off 0.2%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. It's Chuck Schumer's first big test as Senate Majority Leader. The chamber takes up President Biden's relief package this week, and there are still tensions between the Democratic Party's moderate and progressive factions. Schumer says he wants to bring the bill to the Senate floor by the middle of the week. It's already passed in the House. The Biden administration is set to impose sanctions on Russia over its treatment of opposition politician Alexei Navalny. Russian authorities have been widely blamed for the near-fatal poisoning of Navalny, and after he returned from treatment in Germany, he was put in jail. The sanctions could be imposed as early as today. The American father and son team accused of orchestrating Carlos Ghosn's escape from Japan have arrived in Tokyo. The U.S. authorized the extradition of Michael and Peter Taylor. Ghosn, the former Nissan executive, was smuggled out of Japan in a large black box as he fled criminal charges. The Taylors could receive a 3-year prison sentence if convicted. And a new study says that Dublin is the favorite location for finance firms moving jobs into the European Union after Brexit. According to the consultancy firm EY, 3 dozen financial services firms are considering moving some UK operations to the Irish capital or have already done so. Luxembourg is second, followed by Frankfurt. And Target posted comparable sales for the fourth quarter that beat estimates. Earnings were also higher than expected. Meanwhile, Target's digital sales made up 22% of the total versus 12% from a year ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
From high-speed rail to high-speed internet, right now we have the opportunity, dare I say the imperative, to strengthen infrastructure in our cities and create good union jobs. Think of small businesses. Cities are incubators for startups and hubs for mom and pop shops. These businesses create jobs and foster community.
Vice President Kamala Harris there speaking at the Bloomberg City Lab Summit. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bramvis, I'm Jonathan Ferro, counting you down to the opening bell, about 2 hours and 12 minutes away. With your market looking like this, we improve by the minute at the moment. We're down 7 on the S&P, off by a little less than 0.2%. It gets better, Tom. Yields are up by 2 basis points on a 10-year, 144, after the biggest one-day pop going all the way back to June of last year. That was the story yesterday. The follow-through today, just a little bit softer, but as you say, Tom, improving as we count everybody down to Payrolls Friday this Friday.
Very good. And what we're going to do right now, folks, is what we do on Bloomberg Surveillance on radio and television. Lisa, John, and I put our heads together and say, when there's something important, we stop and we cover it. We do that with our Kevin Cirilli, our chief Washington correspondent, who, if you are of means or have fear of your wealth, this is the conversation of the day, if not the week. Kevin Cirilli with the senator from Massachusetts tonight on Sound On. Kevin, I really want to go over this right now. Here's a bankruptcy law true expert. Everyone agrees on that. She's written 11 books, and she is at the fulcrum of going after wealth in America. Let's start with a why. Why is Senator Warren going after the wealthy?
Income inequality. Look, I've covered Senator Warren since her freshman year on the Senate Banking Committee, where she thwarted Larry Summers' chances of becoming the chairman of the Federal Reserve and was able to advance then chairwoman, now Treasury Secretary Janet Yellen. And at that time, her influence was really questioned. But in that span of the past decade, her clout has risen not just within the Democratic Party, but within presidential politics. She was a dominant force during the last presidential cycle. Okay. And now at a time in which many of her ideology is now at the forefront of an inter-policy debate in the Senate this week on stimulus.
How does she play? How does the senator from the liberal Commonwealth play in West Virginia with Senator Manchin?
Well, on energy policy, not too well, but on economic policy, pretty well. I mean, you have to understand here that she is representing a state in which, like other states throughout the country, folks have not been able to work. And for Democrats, they support her policies of let's tax the wealthy, or progressives rather, let's tax the wealthy if we can't get a $1,400 stimulus check fast enough. And so this is a really fascinating moment in the history of Senator Warren's tenure as an American politician this week, and really comes at a time in which the politicians who rode her in her lane to office in the House have been calling on progressives now in the Senate, like Senator Sanders, like Senator Warren, to take an aggressive approach on these stimulus negotiations.
All right, so we're talking a lot about this wealth tax that Senator Warren proposed yesterday. We talked with Greg Valliere of AGF Investments after this came out, and he said that the chances of this passing were nil. We're basically 0%. That said, is there some iteration of this sort of wealth tax that you could see making it into the mainstream of the Democratic Party based on the clout that Senator Warren has and based on the inclinations of the other senators and Congress members?
Bingo, exactly right. And Greg's right on this. I mean, look, the nuances of this, I would agree with Greg that it's a very slim chance of this passing in the immediate short term. But this is injected into Democratic policy debate. And as a result of that, when we're talking about things like infrastructure over the next 6 to 9 months, when we're talking about potential ways to pay for it, taxes comes to the forefront of that conversation.
And John, what's so important here is to compare contrast with the arch liberal with Jeremy Corbyn over in the United Kingdom. I mean, people try to make that illusion here. John, do you see that linkage?
Corbyn who? Isn't that the story? Totally failed. Didn't work. Senator Warren, Kevin, is absolutely polarizing. Being aggressive. You want to be aggressive in a Senate with a 50-50 split. How does that work?
Well, exactly. And to that point, Jonathan, she really, her and Senator Sanders really have all of the control of the progressive movement of the Democratic Party. They know this, they understand this, and they know that this narrow majority that they have by just a tie-breaking vote in Vice President Harris is really the cards that they have to play on the table. Look, stimulus could still very much likely pass, but it's the debates in the future that we've been talking about for the past several weeks here, and the impact that Senator Manchin and Senator Warren, from two very different parts of the party, that they have. Who's going to get the upper hand? Whoever does get the upper hand is going to have a deciding force in the midterm elections.
Well, Kevin, is it about making policy or personal political ambition? What is this about?
It's both. And look, you know, we talk about the Republicans feeling bullish in the House of Representatives in 2022. Senator Warren feels bullish on her prospects of expanding the Democratic majority in the Senate in 2022. And so, you know, she's going to be putting pressure. And I've covered these debates before. The Democrats are going to be putting pressure on those centrists, and they're going to be saying, look, you know, if you double down on a progressive policy in Arizona or in West Virginia or in Montana, Senator Tester, then they would have been able to expand the majority. I'm just telling you, Tom, what they're going to be saying.
Okay, but well, maybe they're saying this, Kevin, because I see it in a lot of the research that's out there. Is Warren and the other liberals, are they going to give away the House? Are they going to cost Nancy Pelosi 7 seats so she's the minority leader?
So they're going to come back at me when I ask that question, and they're going to say, are the centrists in the House going to give away the Senate? Because they feel that they can expand their majority in the Senate. And so there's been a lot of attention on the House of Representatives as a result of former President Trump speaking at CPAC. But Democrats are very bullish on what they feel is an expansive map in the Senate.
Kevin, final question. Let me just squeeze this in, Tom. It's important.
Please.
I don't think this is anyone's base case whatsoever. It's a tail risk. What are the chances, do you think, from your reporting, that we don't get this done? That we don't get this $1.9 trillion bill passed?
I think you could see some last-minute hijinks, but I think ultimately the stimulus will get done. And I go back to last year when we had to continuously report on the delay.
Yeah.
But there's an understanding. This is important. Republicans still agree that there should be hundreds of billions of dollars worth of stimulus. They just don't think there should be 1.9. So everyone's in agreement there needs to be more stimulus.
John, do you see how he answered your question, but he didn't answer my question? Do you see how he does that?
I answered your question.
You did not answer my question. You didn't talk about the House. You talked about the Senate. John, I'm getting
Republicans
no love
have a good
from
shot of winning the House in 2022.
He's answered it. Kevin, good to see you. Kevin Cirilli.
Thank you, guys.
Chief Washington correspondent, host of Sound On Bloomberg Radio, weekdays at 5. Now, Tom, we've spent the last 12 months talking about division within the Republican Party. We've spent the last 7 days really focusing on division in the Democratic Party, and that's where the focus will be in the weeks to come.
Well, the politics, here's the soup. This is a critical interview that Mr. Cirilli has tonight with the senator from Massachusetts. But, John, there's a lot more discussion. I don't see, John, how you get from $1.9 trillion down to $1.4 trillion. I don't see that conversation happening.
Difficult. Senator Warren coming up on Bloomberg a little bit later today with Bloomberg's Kevin Cirilli. Looking forward to that. From New York City alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. With equity futures recovering, we're down now just 5 on the S&P. We're off by a little more than 0.1%. This is Bloomberg Surveillance.
leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City, this is Bloomberg Surveillance live on TV and radio. Here's the price action this Tuesday morning. Good morning. Futures coming in recovering just a little bit as this session grows older. We're down by 4, call it 5 on the S&P. We come at a 1/10 of 1% after the biggest day of gains going all the way back to June of last year. Story for me today, a regional one. US exceptionalism. Is that going to be the story going forward from here? Switch up the board and get to Europe. Europe not looking good. The vaccine rollout struggling. Supply was the issue, now it's acceptance. Euro with a brief break at 120 that we'll touch on with Stephen Gallo in just a minute. 120.27 is where we are at the moment. Down around about 0.2 of 1%. So that's Europe, a struggle. What happened to that global synchronized growth story? Breaking down a little bit, just a little bit. Switch up the board and get to the story out of China. Copper. Copper's ripped this year, and it's not just been a China story, granted. But we've talked about this through the morning. 1, the regulators pushing back just a little bit. 2, you've got the credit story. China's credit impulse rolling over just a little bit. Yet this trade's hanging in there. Copper on the month up by almost 18 percentage points. At what point do you start thinking about the global synchronized growth story breaking down? And Tom Keene, maybe a little bit more about US exceptionalism going forward from here.
Well, that's certainly the story today with the improving tape, John, that we've seen the last hour. I mean, you come off 600 Dow points yesterday and you go, now what? And then now what we're seeing is, yeah, we pulled back, but we've had a good 90 minutes.
I agree with that, Tom. A good 90 minutes ahead of Chairman Powell this Thursday and, of course, payrolls Friday just around the corner. Let's get you some movers. Here's Romain Bostic.
Yeah, those 600 Dow points, a little weaker today. In fact, though, if you look at yesterday's action, guys, and you look at the volume, I mean, we were down about 20+% from Friday's close and actually down maybe about 10% or more from that 3-month average. That gives you a little sign of why we're seeing softness this morning. Some of the individual stories moving markets today might be Target. They did report earnings. They did not provide guidance. Now, the earnings themselves were good. You're talking about comp sales growth that came in a few percentage points above what the street was looking for. The concern here is, though, Target not really confident enough to provide any real guidance. That's causing a little bit of concern here, probably why you're not seeing a little bit more pop in the shares. Kohl's actually did provide guidance going forward. They did say, look for revenue growth in the mid-teens. That seemed to give people a little bit of comfort, and a lot of comfort here for Zoom. Keep in mind, this is a company that reported earnings, posted 300% adjusted EPS growth, about 400% growth here on some of the key revenue metrics. The key issue here is they actually did provide guidance. The guidance actually pretty good. 150% revenue growth for the current quarter, and on an annualized basis, about 43%. That's well above what the street was looking for, Tom.
Romain, I want to go to you on this. I think it's important because Moffett and Nathanson just published moments ago, and they're hugely influential in technology and media. Do you see whether it's the media area of Moffett and Nathanson or it's like Zoom, that this whole thing has legs, that it just keeps going after the pandemic?
Well, the consensus seems to be it does have legs, and we've heard this from a lot of analysts out there that a lot of these sort of companies that have benefited from the pandemic, they benefited not really just from some sort of transitory change in our behavior, but from more structural changes in our behavior, Tom. I mean, a lot of folks are going to be comfortable doing their meetings by Zoom, whether it's for work or whether it's communicating with their parents and their loved ones and doing that on Zoom versus doing it the old-fashioned way, which might have been just calling them up on the phone. So these are structural shifts that definitely are benefiting Zoom. And you're seeing a lot of the other stay-at-home, work-from-home stocks this morning also rallying on the back of this. That growth forecast that they provided, definitely an encouraging sign there. I'll flip up the board here, just a few other quick names here. We did get reports from NIO, the electric car maker. They were not good. That has some concern. That's actually dragging down a lot of the other electric car makers and folks in that space. Roku, this is an interesting deal here. Roku actually buying Nielsen's advanced advertising business. This is a huge deal for Roku, which has been making a huge push into doing more advertising on its platform. This metric, this software that it's buying from Nielsen basically gives it the ability to better track how you engage with that. Basically, when you see one of those ads pop on your screen, do you actually click on it, Tom, or do you just scroll through and watch the next episode of Bridgerton? Nielsen rallying on this pretty hard. Roku, we should point out, actually rallied a lot harder on this, but then this morning they announced that they were going to do sell about 1 billion of shares into the market here, and that's providing a little bit of dilution.
Can I get 90-day fiance on Roku?
You can get that's on Discovery Plus. It's going to be there, man.
Okay, good.
That's all you.
You guys both watch that?
Yeah, John. John and I watch it, and Romain.
Yeah, right after the Tots game.
Right after the Tots game, Romain. That is brilliant.
Romain Bostic, thank you so much.
Romain knows who Tom Keene really is. Bridgerton. Period dramas.
Bridgerton.
Yeah, 90-Day Fiance, bit of Love Island.
Yeah, it's like...
Hopefully Love Island's back in the summer, Tom. Wouldn't that be great?
It would be good. We're anticipating that as well. It's like, more of a modern Bridgerton. Stephen Gallo with us with BMO Capital Markets. He has been patient to listen to our discussion of soap operas, clothed and less clothed. He joins us. He joins us right now. Stephen Gallo, what I love about your notes is the bigger picture, but also huge granularity. What have you seen in the last 48 hours in the foreign exchange market?
Well, I don't think we can talk about anything without mentioning the backup in U.S. rates, particularly in view of the huge run-up in debt that we've seen, both before coronavirus and then, of course, during the pandemic as well. And so the impact that the backup in rates has had on risk appetite, and therefore to a degree risk FX, is what I would probably call something like surface ruptures. And they speak to the instability of the global system because it's dollar-based and the huge run-up in debt. I think for the dollar downtrend, there are basically three components to it. There's a risk appetite component. There's a global growth component. In other words, global growth vis-a-vis the United States. And then there's a U.S. course flow component. So the U.S. course flow component has been highly dollar negative, we think, for the last few months. It's one of the reasons that the dollar isn't higher now. But the risk appetite component and the global growth component, in the context of the backup in yields and what it means for both the United States and also those surface fractures that I talked about, that's where we've been running into headwinds for the dollar downtrend.
Well, let's talk about that. Do you think it starts to bite into the dollar shorts that we saw build up coming into the new year, Steve?
I think it has already. It has in two ways. It's done so in the sense that it's prompted fewer investors to short the dollar, and it's also prompted some clearing out of the pre-existing short positions. So we've effectively paused. And just to put a few numbers to it, this time into Q4 2020, the dollar was, call it 3.5%, 4-ish% lower. Right now, the dollar is 1.5% higher. Same period into Q1 2021. So clearly the pace of dollar depreciation has slowed here, and we're waiting for more information.
Well, let's talk about how to approach G10 then. Within G10, a couple of buckets to talk of. One is the commodity currencies, and the other's the low yielders as well. Steve, how do you approach those two separate buckets within G10 at the moment?
Right. So first and foremost, as it is with almost any cycle, particularly a cycle, an economic upturn, the commodity block currencies within G10, they're associated with things and they export things that are real, that the world needs, that have tangible value, and they're relatively scarce. So if it's copper in Australia, energy in exporting, energy exporting based economies, or opal in Australia. I mean, these are real things that have real value and they're relatively scarce. So I think those currencies within G10 are poised to do relatively well compared with, for example, the euro, where I think we're in the early stages of an economic growth divergence story there that's beginning to blossom. So that's initially, to answer your question, that's how I would break it down.
All right. So I'm trying to wrap my head around what we're seeing in Europe, and John's been talking a lot about how they've lagged behind with the vaccinations and the recovery. And this idea that global synchronized growth or any kind of recovery hinges on a weaker dollar, particularly the commodity story that you're talking about with some of these commodity exporting nations. So how do we get to a weaker dollar if the U.S. is leading the growth?
Well, that's right. It's more difficult, and particularly more difficult when the euro is such an enormous size of the trade-weighted dollar basket. You know, the euro is liquid enough to be an alternative to the dollar, but time and time again, ECB officials and other European Union policymakers, they tell us that they don't want a strong euro. Well, you know, that's having your cake and eat it policymaking, but that's effectively what they're telling us. They're telling us that they want to continue to hoard trade surpluses. They're going to continue to make it harder to sell into their market, the single market. And so that's a trade balance story for the Eurozone, but it's also a growth story vis-a-vis the United States. I have to say, based on what we've seen over the last few months, in terms of the direction that things are going, it looks like it's going to be more regulation, much higher taxes, and very slow growth for some time to come in the European Union.
Okay, so what does that mean in terms of the euro going forward? I know we've been talking about this, but just how much are people off sides with the trade that you're expecting?
I would think that the long euro dollar trade is reasonably crowded. I don't think the positioning in nominal terms is as big as it has been in other cycles. But for example, compared to you know, if you're looking at 3-year average or 3-year maximum long euro position, it's reasonably crowded, though not huge. But I think that this is one, I mean, you're raising important points, because this is one of the things that the dollar bears were counting on, which was that the euro would function as a clean or a smooth alternative to the US dollar. But time and time again, we get into a position where it just simply can't do that.
Stephen, love catching up. Always good to see you.
Pleasure.
Stephen Galler there, BMO Capital Markets European Head of FX Strategy. Tom Keane looking at futures intraday right now. Almost totally recovered the losses overnight. Futures down, not even a tenth now, off by around about 2 points.
We're going to get green on the screen on futures. And John, I'd also notice the VIX now trading below the good side of where it was yesterday during that huge move. There it is, a 22.99 VIX, John, right on script. That's a really important signal this morning.
Things starting to improve. Is it too early to do the estimates for payrolls? I mentioned it yesterday and you both said yes. Can I do them now?
Do it
You
now.
did it
'Cause I
yesterday
got a
anyway.
number.
I'm just
So you
asking
can do it now.
I'm asking for permission and then seeing if you say yes, and
What do
then
you
I'll do
got?
it anyway.
Yeah, well, clearly.
All right, the high is 410. The low is negative 35. Still pretty widespread. The 410 coming from Citi at the moment, Tom.
Yeah, they just reaffirmed that this morning, John, 410,000. It's amazing, the spread. I mean, I don't have any strong conviction here, John, other than I'm really going to watch ADP tomorrow.
Median 188, the previous 49. Here we go. You let me do it. I did it. We're all friends. Alongside Tom Keane, Lisa Bravitz, I'm Jonathan Ferro.
We're friends.
Coming up
600 Dow point
from
moving,
our
you're
exclusive
friends.
conversation with JP Morgan Chairman and CEO Jamie Dimon on Dow
Jamie
points.
notices the Dow went up
He's
600
trying to
points
Jamie on
yesterday.
Dow points and whether it's an antiquated measure of the equity market in the United States of America.
Antiquated. It is
That's
what
not what
all
he's gonna be
across
talking
America
about.
we look at.
More on that coming up
Yes, Mr.
on the
Dimon.
program.
Friends,
The
huh?
Dow, I'm not even going to quote it. The S&P 500 down almost a 10. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. vaccination campaign has regained the momentum it lost in the severe weather last month. It posted 3 consecutive days of 2 million shots or more since Friday. Authorities are expecting another immunization surge in the coming weeks. The recently authorized Johnson & Johnson vaccine is being added to the mix. President Biden's choice to head the Securities and Exchange Commission, Gary Gensler, goes before a Senate committee today. And some might say the timing is just perfect. A stock market drama as many calling for more regulation of Wall Street. Gensler has experience as a markets regulator during the financial crisis. He was a chairman of the Commodities Futures Trading Commission during the Obama administration. In China, President Xi Jinping wants to mobilize the country for a tech revolution to reduce its dependence on the West. At the annual meeting of China's legislature, Communist Party leaders will approve a 5-year policy blueprint. It's aimed at cutting China's reliance on other countries for components such as computer chips. Meanwhile, Beijing will make big bets on technologies such as hydrogen vehicles. And Hertz has received an offer from Knighthead Capital to buy the company out of bankruptcy. According to court papers, the price for the rental car company could be as much as $4.2 billion, and the sum would depend on existing lenders' desire to take part in the financing. And Nike's vice president and general manager of North America has abruptly left the company. That's after a Bloomberg Businessweek report about the executive's son operating a business reselling sneakers and using a credit card in her name. Earlier, Nike said that the executive was not violating company policy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures recovering. Futures down just 3 points, off by not even 1/10% after a really big day of gains. In the bond market, yields are higher by a couple of basis points to 144. No drama on the screen today. Euro dollar 120.30, off by about 1/10, Tom.
Yeah, and again, the VIX comes in. John, I mean, the last 20 minutes have been very constructive, haven't they?
The tape improves. The tape improves, and the outlook gets better in the last 24 hours based on what we've seen on the vaccine front.
Stay with us on radio and TV through the morning. We're going to have a lot more on this, particularly after what we saw yesterday. He is the offspring of Greek immigrants. He went to Tufts University, and he wrote an essay on Shearson, way before it was Shearson Lehman. The essay was so impressive, a guy named Weil hired him. And thus began the banking career of one James Dimon, of course, of J.P. Morgan, their chairman and their chief executive officer. A Baker Scholar at Harvard, Jamie Dimon went from Bank One out in the Midwest to commanding Fortress Dimon at J.P. Morgan. Here he is on COVID with our Ed Hammond.
Getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats, Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we're just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and are getting the help, you overflood the system, you do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion, $1 trillion that's unspent. That's before this $1.9 trillion. So there will be money, there's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. You know, I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But you know, I would suspect there's a pretty good chance you're going to see rates going up, and you know, people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JP Morgan to actually have people physically coming back to work?
It's very important. I mean, I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. But so I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. I mean, most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So what before was like a deep dive question, now looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And, I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And, so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible. So that question can't even be answered until June. But I do think you may see some companies do it. I mean, I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure, and I would say carrots and sticks, not mandatory.
Jamie Dimon, JP Morgan Chairman and CEO, speaking with Bloomberg's Ed Hammond. Loved how Mr. Dimon just slipped that in, Tom, very subtly. I wouldn't buy treasuries here.
Yeah,
just as Ed was trying to get to the next question, I wouldn't buy treasuries here.
Let's go to our world on this, John, which I thought was frankly missed in the interview. They did some promotions and movement yesterday. Joyce Chang, Bruce Kasman will stay on at JP Morgan Research, but the derivatives guy was loftily promoted.
Marko Kolanovic, you're talking about, Tom?
Yeah,
Chief Market Strategist, yeah. Caught up with Bob Michael at JP Morgan on the asset management side recently. Just on the bond market briefly, Tom.
Yeah.
He's in the same camp as his boss.
Yeah.
Wouldn't buy treasuries here, pushing back against that story. What a shock. Adding risk. I'm sure he is buying treasuries somewhere, but you get the picture. He wants to buy other things, risk assets.
Well, it's a ferment there, and that's what James Dimon wants. I mean, let's be honest. It's the best conference call on the street. And to me, John and Lisa, what is so important here is the mass, the scale of JP Morgan. What do they do with a 6% economy? The cash they're going to throw off. Where does that go? I mean, they're gonna buy the palace on Park Avenue, Lisa. Rather, they're going to build the palace on Park Avenue. I mean, you'll be the first to enter the door, I'm sure.
Something like that, perhaps. I will just say that it really benefits the banks when the yields go higher. And I just do want to point out, Jamie Dimon, perhaps not the best prognosticator on Treasury yields. Back in 2018, August, he did say, he predicted that 5% 10-year Treasury yields was a distinct possibility and that Treasury yields ought to be 4%. So, he's been calling for this for a while. That
you
said,
can say it was a possibility.
It was a possibility.
Say they ought to be there.
You could say that. Sure, you could say whatever you want to say. But there is a difference between higher Treasury yields that are, 1.75% and 5%.
Lisa, they're watching this. We're never going to talk to Jamie Dimon with the
I don't think he cares about what we've got to say. Stocks up 18% this year, Tom. Stocks up 18% this year, and the outlook's getting better. What do you have to say about the Zoom world? Let's talk about that just for a moment. The fact we're talking about the Zoom world with the word Zoom in, Zoom won. And Zoom's going to win again this year as well, looking at the forward guidance they've put out for this year, Tom.
technological progress and you do it in time. You know, it's like a war, frankly. It's like the difference between the United States in autumn of 1941 versus where we were in 46. Why is this any different?
I think the key, though, with Zoom is how much more adoption can there possibly be?
Yep.
Have we seen a peak as we get to Zoom fatigue? I know at home we have some serious Zoom fatigue going on.
I think Jamie Dimon's point on seeing more clients as well.
Yes.
These guys on Wall Street, they want to see their clients again. And I don't think that goes away.
The dividend is 2.4% on JP Morgan. I mean, it's trading like an electric utility.
The capital returns are huge.
Go to cash.
That's part of the attraction, isn't it?
Right, Tom? Go to cash.
Coming up, David Costin, Goldman Sachs Chief U.S. Equity Strategist from New York City this morning. Looking forward to that conversation. Good morning to you all. Futures in 4, we're down 0.1%. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Relative to what we've seen over the last week, I guess you can call this stability. Good morning to you all. This Tuesday morning, equity futures in 0.1%. No drama on the Russell off by 0.6, on the Nasdaq off by 1/10 after a massive move in yesterday's session. The biggest one-day pop going back to June of 2020. Coming out of the financial crisis into a new decade, increasingly we talked about decoupling. The United States decoupling, the divergence between the US and Europe. And I can just feel that conversation starting just a little bit more, given the vaccine rollout in America, given the data in America, given the fiscal stimulus effort in America. Just compare and contrast those 3 points to what's happening in Europe. Switch up the board. Euro dollar, a break of 120, briefly, 120.28, off by 0.2%. Me personally, for whatever my view is worth, I've been surprised by how well this euro has held up in the face of what's going on. Going on not just in the economic, but also in the bond market. Finish on this. In the bond market right now, US 10s, Italian 10s, German 10s. Yields on a German 10-year right now, negative 32 basis points, up about a basis point on a day. Italian 10-year yield up about 4 basis points on a day, in line with what's happened with America. But where's the pushback come from? Not from the Federal Reserve, Tom. It's come from the ECB about undue tightening. And we had another ECB official this morning comment on the same thing, uncomfortable with what is happening with this bond market because they're not as comfortable with what is happening in that economy. And the compare and contrast on a whole load of points between the US and Europe right now, the read across is obvious.
Do we agree, John, that it's widened dramatically in the last 12 weeks?
I think we can agree it's not narrowing, and that's the issue for Europe right now.
Yeah, there's no question about it. I would suggest on the vaccine front, it's a much, much wider landscape and ocean right now. Matthew Luzzetti joins us, just brilliant with Deutsche Bank. They have been on fire, including Institutional Investor Awards, and we're thrilled their chief U.S. economist could share time with us this morning. Matthew, I want to go back quickly here to Vice Chairman Clarida's speech, where he says robust demand. Define the Vice Chairman's robust demand into next year.
Sure. Thanks for having me. I think no doubt we are, in our mind, going to have the robust demand that the Vice Chair outlined. We recently upgraded our forecast. We expect to see a fiscal package put in 1.6, 1.7 trillion. We think that leads to growth this year around 7.5%, with a few quarters of 8% plus.
Wow.
As we head into next year. So this is an economy that will be hit with a lot of fiscal stimulus at a time where we're reopening, and as you mentioned, vaccine rollout is going pretty well and picking up. Those forces coming together should absolutely lead to robust demand over the coming quarters.
And for all of you on radio and TV, this is absolutely important that Deutsche Bank is out with a 7-8 handle. Everybody else is catching up with them. You talk about fine-tuning after you see the stimulus. In March, when you fine-tune, can you even perceive fine-tuning up from 7.5%?
Yeah, we're definitely in a new world where fine-tuning was upgrading our forecast from 6.3 to 7.5%. The fiscal numbers are just so large. We'll find out, I think, where the Senate goes over the next week or two. It's possible, that it comes in closer to the $1.9 trillion price tag that President Biden has outlined. But those are, I think, more moderate risks around our view at this point. I think 7.5% is very robust growth. We expect the unemployment rate at 4.2% at the end of the year. Those are it's a very sharp recovery relative to where we were expecting just 6 months ago or so.
Matt, China is striving for stability. Maybe that's exceptional in the world we're in right now. Europe is struggling just to get by, and the United States is just going for it, pledging to go big. Do we start talking about America decoupling again?
Yeah, I think that narrative has certainly picked up some steam. The fiscal story, I think, is a really important one in the U.S. Thinking about $5 trillion in aggregate in fiscal stimulus that we've had since last year, that plus the vaccine rollout going positively. I think from the market's perspective, the question is how much of that is already being priced in or not. And I think over the past few weeks, at least from the rates market, from thinking about the Fed, we had a very aggressive repricing there. So the market has brought forward rate hike expectations into early 2023 at this point. And so I think a lot of that is probably already being reflected, that optimism in the divergence that is likely to take place.
Given the character of the American economy, Matt, do you think the U.S. economy can lead the global cycle, or do we still look to China for that?
Yeah, I think the nature of both the recession and the crisis and the recovery is just very different than typical dynamics around recessions. And that is driven by the fact that services sector, the domestic economy, largely drove the decline and will largely drive the recovery. We had seen this big pickup in goods spending. CapEx has already normalized. Housing has already normalized. So the lagging part is really a domestically oriented services sector that we expect over the coming quarters. And so that's just a little bit of a different dynamic than we typically see around recessions.
And talking about strange dynamics, I really keep going to the inflation dynamic here. And if you look at break-even rates, you can see that inflation expectations over the next 5 years are the highest on record versus the inflation expectations over the next 10 years. The idea here that it's going to surge up and that prices will increase a lot and then it will come back down, the pace will normalize. Can you talk about what we could be missing? I mean, they keep making fun of me, John and Tom, about trying to see around corners, but what corners can we see around when it comes to inflation possibly continuing on a trajectory that's much higher than people are expecting over the longer term, or whether this transition to a lower inflation kind of regime is going to be smooth?
Sure. So I think over the coming months, no doubt we will see sharp rises in year-over-year inflation. And as Chair Powell has highlighted, that is primarily due to base effects. We had historically weak prints last year. Those are rolling out of the calculation. And so just mechanically, you're going to see inflation rates rise. On top of that, you are likely going to see some price pressures in those categories at the epicenter of the crisis: airfares, hotels, restaurants, those types of things. So from that perspective, this big sharp rise that we're going to see in the near term, I think makes sense, what you're seeing in terms of the differences in break-even inflation rates. I think beyond that, we do expect a moderation in inflation as our baseline expectation. But I think the risks are skewed to the upside for the first time in a long time. And that's primarily due to what we view as kind of regime shifts, both from the fiscal side, spending significantly and not as worried about deficits and debt, and clearly a regime shift from the Fed's perspective where they are not preemptively tightening and they're actually encouraging inflation to move higher.
This is really important, Matt, and there's a question of whether the fiscal stimulus as proposed, the $1.9 trillion bill that's expected to pass halfway through this month, as well as the follow-on infrastructure spending that people are expending, is that alone enough to trigger inflation that's substantially higher than what's currently priced in over the longer term?
Yeah, I think when we look back over history, it's tended to be a confluence of events that leads to higher inflation. So if we look back to the mid-1960s, we did have a big fiscal package at that time. So there are parallels there. If you look back at the Fed during that time, there's a bit of a similarity there as well. They thought that they could keep pushing the unemployment rate lower and lower without getting inflation pressures. But I would add to that there was this huge jump in Medicare and Medicaid inflation during that period. So I think you had that confluence of events. You had inflation expectations at that time that were not well anchored, which led to this big surge. This time around, you are certainly getting the fiscal stimulus. And under reasonable views, you could get the output gap to plus 4% by the end of this year. You do have this regime shift from the Fed's perspective as well. So there are definitely a few key elements there, which are, at least in our mind, and I think in the market's mind, has shifted the risks around inflation to the upside rather than to the downside.
This is fascinating, Matthew. We could go on and on this. And it's just simple. With your number of 7, Ellen Zettner over at Morgan Stanley, that's a small American bank, Matthew, they're at 7.5%. If we get the optimism I'm hearing from you to 8% plus, is it an all boats rising American economy, or is it still a two-part economy?
I think that's really a critical question from the Fed's perspective, especially because as they've gone through this policy review, they've talked about maximum employment being a broad-based and inclusive objective. So simply the unemployment rate or even the employment to population ratio is not a sufficient statistic from their perspective for thinking about the labor market. And there I would highlight that although we think when you get back to the pre-virus level of activity next quarter, and you actually get back to the pre-virus level of GDP by the end of the year in terms of the pre-virus projection, we really don't expect that you get down to the 3.6, 3.5% unemployment rates until later next year. So there is going to be this divergence or difference between how quickly the demand side of the economy and GDP recovers. And it's going to just take longer, I think, for the labor market side to recover.
Matt, I don't think we should gloss over what you just said, because for decades we would sit here and say that is not a critical question for monetary policy and central bank policymakers. And now we're saying it's a critical question for the Federal Reserve. And then you've gone through a list of data points, not just unemployment, but also employment to population, which is where people are increasingly drawing their attention and focusing on for driving Federal Reserve policy. What is the metric then? If it goes beyond even employment to population, if it goes beyond even recovering the amount of people that have dropped out of the workforce, what is the metric to look at? What guides the Fed?
Yeah, I think at this point, the answer is we don't know, and to a certain extent, because we haven't gotten great clarity from them. I noted, Chair Powell and both Governor Brainerd really did highlight the employment to population ratio, but that has its own issues. There's structural declines as our population ages. There's going to be structural declines built into the employment population ratio. I think we really do need to rethink and think about a new dashboard for this Fed, which is different from the dashboard that we created under a Janet Yellen led Fed, prior to this COVID crisis. And it will include not just these aggregate statistics, but it will include a lot of these other distributional statistics. It will just be a broader array of things that we have to consider.
Matt, when you complete that research, that study, bring it to us, won't you? What is on the dashboard?
Absolutely.
Matt Lazzetti, Deutsche Bank chief, US economist. Good to see you, sir. For those of you that follow the Atlanta Fed GDP Now GDP forecast, Tom Keene, it has a 10 handle. It has a 10 handle.
Yeah. It's not that I have trouble with that series, but it's so far out front and pendulum, almost like 80.
Okay, guys, I'm going to cancel order to sell short Bitcoin. It takes too long, to be honest, until it will get executed. So let's wait for better time and maybe we'll enter at the better price Bitcoin. Okay, so order to sell short Bitcoin cancelled.
On social justice, Vernon E. Jordan Jr. has died, Tom, according to a family statement in the last couple of minutes.
At 85, and what is so important here, folks, is to be 400 kids at DePauw, and you're the only black guy, ages ago. And what's so important about Vernon Jordan, a great advisor to President Clinton, was John Farrell. This is a guy who was early. It's not who he was. Yes, that was noted. It's the when of Vernon Jordan.
Some really sad news in the last couple of minutes then from New York City this morning. Good morning. Vernon Jordan has died, aged 85.
With the First Word News, I'm Ritika Gupta. President Biden reportedly will announce what's being called a historic partnership in the fight against the coronavirus. According to the Washington Post, Merck will help make Johnson & Johnson's new single-shot vaccine. That would be an unusual agreement between two fierce rivals, and it could lead to a big increase in the supply of that vaccine. And President Biden's choice to head the Securities and Exchange Commission, Gary Gensler, goes before a Senate committee today. And some might say the timing is just perfect. A stock market drama has many calling for more regulation of Wall Street. Gensler has experience as a markets regulator during the financial crisis. He was a chairman of the Commodities Futures Trading Commission during the Obama administration. In China, President Xi Jinping wants to mobilize the country for a tech revolution to reduce its dependence on the West. At the annual meeting of China's legislature, Communist Party leaders will approve a 5-year policy blueprint. It's aimed at cutting China's reliance on other countries for components such as computer chips. Meanwhile, Beijing will make big bets on technologies such as hydrogen vehicles. And Macy's is tapping the junk bond market to capitalize on record low borrowing costs. The department store chain is selling $500 million of senior notes to help fund a tender offer of the same amount. Macy's reported better than expected holiday sales. It also predicted that pandemic pressures will ease later this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. leader are you?
I'm a leader that works on figuring out destinations that we should aim for, and then chooses the direction.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? You know, and we just throwing money at people at one point. So, and there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it.
The banker James Dimon speaking on Fortress America, and certainly the news has been better here, much better news on the pandemic as well, and we see it in the markets. A big day yesterday, and really pretty good follow through today. A little bit negative S&P, -7 right now, and this is truly a joy with one Barry Ritholtz, of course, of Bloomberg Opinion, in his wonderful long-form conversation, Masters in Business. I can't say enough about this, and a conversation with one of the most misunderstood people on Wall Street, and that is Peter Lynch of Fidelity. Barry, I want to go back to the time of Magellan, 1977 to 1990, where Peter Lynch reinvented portfolio construction. He had the courage to overload on the growthiness of Fannie Mae. At the time, Barry, that was a revolution.
It certainly was. He took over Magellan. It was a $20 million fund, not really well known, and for good reason. And his approach was really systematic and really insightful. You know, where some funds have 60, 70, 80 different holdings in the stock. He basically ended up with 1,000, and he would buy a broad cross-section of holdings and then turn around and just pair what wasn't working. And it was really a savvy way to do it.
He once screamed in a meeting I was at, "I don't care about your number one holding. I care about your analysis, rather security analysis, fit into the Lynch method."
So it's crucial. Remember, he's essentially the guy who invented GARP, growth at a reasonable price. And so understanding the business, understanding what's behind it, understanding all of the underlying data points is, you know, what he did. He said you have to flip over 10 rocks to look at 10 different companies. 8 are probably fairly priced. 1 is going to be expensive, and 1 is interesting. And the person who flips over the most rocks wins. So he was all about doing the deep dive, doing the research, and identifying those companies that had growth potential.
So, Barry, we're talking about Peter Lynch because you actually named him the greatest long-term track record holder when it comes to stock picking, individual stocks. And it sort of raises a question at a time when people are wondering the fundamental relationship of a company's story with the stock price in the era of GameStop and AMC and fiscal stimulus. Has the era of stock picking been greatly diminished by some of the policy intervention that we've seen?
So let me reference Bill Miller as opposed to Peter Lynch on this particular question. It's not that the era of stock picking has been diminished by the Fed or anyone else. It's that the era of getting value for paying for stock picking, when many of the funds out there are just closet indexers, that's really problematic. So Miller says we want a high active share. We want a portfolio, if not concentrated, well, certainly not hundreds of names, so it looks like the index. And you have to adapt to whatever the circumstances are. If you go skiing, there's always signs up that say, be aware of changing conditions, rocks, ice, snow, whatever. Fund managers are the same. If the Fed is taking rates to 0, well, you can't just rail against that. You can't tilt it windmills. You have to build that into your management process. And if you don't, well, you're going to be very disappointed when the market took off in 09 and 10 and you were just, you know, impotently shaking your fist at it. That's not what people hire managers for.
All right. So, Barry, how does one determine whether a fund investment manager is a closet indexer or whether they're actually doing something different that can differentiate themselves and actually make them a stock picking winner?
Well, obviously, the active share is the biggest and easiest way to quantify that. If somebody's performance and holdings look and behave like the index, and you could quantify exactly to, you know, the second decimal point how much that is, well, then you're paying a lot of money for and not getting a lot of value. On the other hand, if you want to perform differently than the market, you have to look very different than the market. And the risk with that, you know, when we see people like Kevin Landis or Bill Miller or Catherine Wood, when they're outperforming to the upside, that's because they look so different than the market. But people forget, and a lot of people have had great track records punctuated by big drawdowns and bad years. So even if you don't look like the market, there's a chance, that's what risk is, there's a chance that you're not going to generate the expected returns of those portfolios. There's safety in indexing. There's glory if you're a great stock picker, but there's as well a lot of risk also.
Barry Ritholtz, thanks so much. Greatly appreciate it. Just fabulous with Peter Lynch. Look for that coming up here, of course, with Barry's podcast as well. Balance of power. Lisa, the markets right now, I mean, we've got back a little bit from the enthusiasms of the last 2 hours, but what I've noticed this week, Lisa, Monday, Tuesday into Jobs Day and all the enthusiasm for it, a lot of economic data, is these GDP numbers really start to creep up.
Yeah, they're creeping up to really high levels. I want to go back, though, to something that Barry was talking about, and this is actually really important, especially as you've got pension funds looking to hit those 6, 7, 8% bogeys in order to meet their obligations. They're looking for someone who can deliver that at a time when interest rates, even amid some of these GDP numbers that we're hearing, are still 1.4% for a 10-year Treasury. This isn't going to get it done, and the question is, how do they get that? And the question, you know, in my mind is, how much risk are we embedding in the system in our quest to get there at a time when we really have already baked in a lot of the good news, Tom?
And then also on a broader impact, Lisa, is the wall of money to be presumed from 1.x trillion. And you really wonder what that does to the incentives of capitalism, the incentives of investment, and indeed the incentives of society. I mean, how many new cars am I going to see on Fifth Avenue?
Yeah, that's a big question in terms of the actual manufactured goods, but then also how much more will people go on vacation? How much more will people go and get their nails done? And these are some of the aspects of the economic recovery that are highly uncertain right now.
Are you saying I need to get my nails done?
I've been trying to tell you for about a week now, Tom.
It's terrible.
I mean, really, what is vet bill doing to you?
Well, you know, the reason I can't get my nails done is what it costs to get the dog dressed at the dog parlor with Kyle. It's not even like an associate. Kyle's billing me like a partner at a law firm.
Along with the tutors for afterthought.
Yeah, it's terrible. Futures at -4, Dow futures -3. Stay with us on radio and TV. Balance of Power. Ken Benson. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now. Your Tuesday morning price action looks like this. We're down 4 on the S&P. We're negative 0.1%. Let's get straight to it. We begin with the big issue. America back on top.
U.S. exceptionalism.
We're starting to see economic growth pick up.
Some slowing of momentum in China.
A slowdown in credit growth in China.
There's clearly a bit of a handover going on.
The U.S. fiscal stimulus plan, this kind of gargantuan fiscal stimulus package.
The enormity of the stimulus.
Vaccination rollout is surprising in a good way.
The vaccine count is getting better.
What is the number one determinant of where the economy will be?
Getting this vaccine to roll out faster and faster.
That vaccination campaign is critical for global growth.
Europe probably lagging behind.
The vaccine rollout is certainly slower.
They're just not getting it.
Very slow growth for some time to come in the European Union.
The weight is clearly shifting towards the U.S.
Let's bring in the Bloomberg team. Sarah Ponzak, Kaylee Lyons. Morning, Sarah.
Good morning, John. Well, now we have China's top banking regulator warning about bubbles, but particularly foreign asset bubbles in the U.S. and in Europe, and then also in the local China property market. Well, according to the South China Morning Post, the chairman of the China Banking and Insurance Regulatory Commission said that the, quote, side effects of aggressive economic stimulus policies in the U.S. and other developed nations have surfaced in the U.S. stock market and also identified the U.S. stock market as the greatest bubble risk. He also added what you're looking at here. He said, from a banking and insurance industry's perspective, the first step is to reduce the high leverage within the financial system. Well, to that, he does have a bit of a point. Take a look at corporate debt as a percentage of GDP and how that has just grown over the past decade or so. It's just been a slow grind higher ever since the financial crisis in an environment dominated by extraordinarily easy monetary policy. Now, as it stands, corporate debt as a percentage of GDP holds above 50%. That is just about a record high. However, at the same time, though, even though he did warn about foreign asset bubbles over the past year in the aftermath of a COVID-19 fallout in the stock market, Chinese equities have actually outperformed. The CSI 300 over a one-year period is up more than 30%. Meanwhile, yes, we have seen an extraordinary, remarkable global equity rally. The S&P and the stock 600, for example, in Europe, have not risen as much. I'll also give you one example because we did see an effect in the Chinese stock market overnight, the CSI 300 falling more than 2% at a time after these comments were made. Well, China's largest stock, that's Qichao Mutai, it's down over 20% in a matter of 9 days. That means it's lost more than $100 billion in value, John.
America looking to go big, China looking for stability, Europe struggling. Sarah, thank you. Here's a headline out of Europe for you. A little bit earlier on, the ECB official Fabio Panetta said the steepening of the nominal GDP-weighted yield curve we've been seeing is unwelcome and must be resisted. Try and reconcile that with the data we're seeing here at Bloomberg. The ECB slowed the pace of gross pandemic bond buying last week. Hard to reconcile those two things. The complaint about yields going higher, the willingness to do more, and then not following through last week. A bit more on that later. You put it all together, the US, America right now, back on top with the vaccine rollout, back on top with the economic data, back on top with the fiscal plan. Kaylee, it's looking good.
It's looking good, John, and if we take ourselves back to the end of 2020 when all of the 2021 outlooks were coming on, the consensus was value over growth, small caps are over large, international over U.S., but that doesn't really seem to be taking shape. In fact, investors can't seem to lose their appetite for U.S. assets, with stocks here sitting just shy of all-time highs once again. And looking at the monthly fund flows as a proxy, U.S. equity ETFs saw $85.5 billion worth of inflows in the month of February. That is a record, and it underscores optimism, as you were saying, about the recovery and about the vaccine rollout. And of course, U.S. exceptionalism used to be about big tech, how heavily weighted our markets here are toward some of those high-growth stocks. And that, of course, has brought valuations within big tech to the highest since the dot-com bubble. Looking at the price to sales multiple here for the tech sector, just shy of the peak back in 2000. But for the broader S&P 500, it's looking the most expensive on record. So it is likely charts like this that China is looking at when it talks about those bubble concerns. But of course, now the story isn't so much about tech as it is about growth and inflation expectations, a dynamic that has, of course, driven yields higher, and along with that actually aided the U.S. dollar. Talking about consensus calls for 2021, a weaker dollar was supposed to be the story, but instead the greenback is stronger now than it was when it started the year. And HSBC says it's really coming down to a matter of what story matters most. The global reflation story, in which the dollar would weaken because of its status as a safe haven, or a U.S. exceptionalism story where data continually surprises to the upside. Our economic recovery is looking a bit better, and that would lead to buying of the dollar, not selling it. And it seems the exceptionalism narrative is the one that's winning out right now, John.
Kaylee Lyons, thank you. Much more on that throughout the hour right here on this program. Things are looking better in America Are things too good? Alpha Omega's Peter Cicchini raising concerns about the fallout from excessive fiscal stimulus and writing the following: it can be quite effective at prompting an inflationary overheat if the stimulus significantly enough exceeds the amount of the output gap. The first 2 rounds of stimulus have largely filled that gap. Peter joins us now for more. Peter, just run me through that, the maths there. We've already filled the gap, or you think we will fill the gap pretty quickly?
I think we've just about filled the gap with the $900 billion package. And, you know, I think it should come as no surprise when you spend roughly $5 trillion, which is about 20% of GDP, that you're going to get GDP growth of 6 to 7% in the next quarter. And by the way, whether it's 6.5% or 7.5%, to me, that's a bit of a rounding error. And John, I think the most important piece of this, which has not been discussed very often or often enough, is that you have this massive increase in demand coming from stimulus, which is inorganic, right? It's an inorganic process. It's stimulus-led, and it's meeting supply chain constraints. You know, we're seeing containers, shortages of containers where they need to be. We're seeing shortages of semiconductors. We're seeing soft commodity prices rise of course, on things like weather, but also on COVID-19 related issues. And even if the vaccine continues to roll out and, you know, the majority of the population is immunized by Q3, those supply chain constraints really are, for me, in combination with the closing of that output gap very quickly and exceeding it by quite a bit. It's the combination of those two things that really has me a bit worried about higher than expected inflation.
It's also the permanency of some of those conditions, whether they last, Peter. And many people, Pete, saying that it's transitory. You're putting out the argument that we're about to see the risk of non-transitory inflation materialize. Why, Pete?
Well, you know, the word transitory is a very soft word, first of all. So you have two things. You have severity and duration of the situation. So it's one thing to get 3% inflation, and it's another thing to get 4 or 5% inflation. And whether or not transitory means a quarter, 2 quarters, 3 quarters, I think it's easier to judge what's transitory in hindsight than it is at the time. So for me, the importance here is that it puts the Fed in a little bit of a tricky position. It clearly has communicated it does not want to hike, and I think it's going to stand by that unless for some reason inflation is incredibly high, which I don't expect. But at the same time, look, the 10-year yield has moved from 60, 70 basis points before the election to 1% in January to about 1.5% now. And another 50 basis point move, to me, that puts us in a position where risk assets would come under considerable pressure. That would put us at 2 standard deviations above a 35-year secular downtrend in rates.
This is a high-class problem to be discussing, though, isn't it, Pete, considering what's happening in the rest of the world? China's seeking stability, Europe's struggling. Headline across the Bloomberg right now from Nikkei, Tokyo to seek extension of virus state of emergency. We came into this year, and I think that's something I want to sit on just for a moment, Pete. We'll talk about the Fed a little bit further down the road on this program. We came into this year looking for synchronized global growth, and I'm not seeing much synchronization out there at the moment. I'm seeing Europe struggle. I'm seeing the Chinese recovery already in place, and it's maturing, and they're looking for stability. And I'm just seeing the US looking to go big, go bigger. Pete, do you think we get that synchronized global growth or something much more broken down than that?
Well, I think you've been making the point very well this morning. I have to laugh when I hear Chinese officials come out and complain about bubbles in the U.S. Even if that's correct. I mean, it's just a ridiculous assertion given everything that they do to manage their economy and all the bubbles that they're seeing there, which go unidentified. But look, I do think the recovery is going to be somewhat uneven globally. One of the benefits that we have as the United States is we have the largest economy in the world. We can use our Federal Reserve to monetize the deficit issuance that's going on. And we've come out big and we've come out hard on stimulus in a way that Europe, which does not have a fiscal union, can do. And so that's our advantage. And we also don't have the demographic issues, for example, that Japan has. So I do think that puts the U.S. in a better position, certainly relative to Europe. As you know, I've liked the dollar for some time. I did not think it would weaken the way most did. However, once again, I must say, the Fed's in a difficult position. I think the best it can do, John, is not announce a maturity extension program. That is, it may let the long end of the curve do some of its work for it relative to the inflation that I think is coming, rather than hike.
Pete, good to see you. Pete Cicchini will be sticking with us. It's all about the global cycle. Who leads the global cycle? Does the US decouple? Can the US actually lead the global cycle? Over the last decade or so, it's all been about China. Looking forward to catching up with Mike McKee a little bit later in the programme about all of that and more. Looking ahead to the opening bell, 20 minutes away. Futures recover. We're down 3. We're off by about 1/10% of the market desk with your movers. Here's Abby.
John, let's start out with a big earnings mover. And of course, I'm talking about Zoom Video. Shares are popping sharply higher after the company put up a big beat and boost quarter. They beat adjusted earnings by 55%, revenues by about 9%. Importantly, the forecast for revenues is better. Of course, there's a question of whether or not we'll be using Zoom as the pandemic recedes. That forecast suggests we will. Now, this, of course, is a poster child for stay at home, but we have the reopening trade still working. We have airlines and cruise lines up once again, and United Airlines also one reason for the fact that this company is popping. They have ordered another 25 737 MAX planes, suggesting that they do see more customers ahead, of course, on vaccine optimism and reopening optimism. Interesting, though, John, finally, if we take a look at the reflation trade, we do have rates up slightly, but the bank's really not following. So you have to wonder, is this some sort of an inflection or saturation point in terms of the banks up? If you can believe it, out of March of last year, the XLF up about 90%, really following that back up in yields. But again, today, a little bit of a pause here, John.
A pause ahead of the opening bell, Abby. Thank you. Coming up, a busy stretch for the Fed. Speak kicking off with officials focusing on the labour market. That conversation coming up next with Alpha Omega's Peter Cicchini and Stifel's Barry Bannister from New York. This is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
K-shaped recovery is not acceptable. That's the bottom line. We need a recovery that includes everyone and, in fact, has most rapid recovery for those at the very bottom who have been bearing most of the weight of the pandemic.
San Francisco Fed President Mary Daly, just one of the Fed speakers downplaying market concerns, focusing instead on the labour market. Richmond Fed President Tom Barkin telling Bloomberg in an interview with Michael McKee that he's, quote, focusing on how we're going to support participation in the workforce and how we're going to support redeployment. Mike joins us now for more. So, Mike, let's build on that, if you can. What are they focused on? Where is it in the labour market? What data point?
Well, they're focused on the unemployment rate and maybe the
augmented unemployment rate, the number of people who've dropped out of the labor force because they can't find a job. There's no jobs out there at the moment, which they say is around 10%. And that's their story, and they're sticking to it. The idea that the economy is picking up, so it's natural that the yield curve starts to rise. And boy, is the economy picking up. Take a look at where we are now. The consensus of Bloomberg, the survey that Bloomberg does of economists is for first quarter growth to come in at about 3.5%. But the Atlanta Fed GDP Now indicator, which is admittedly just a snapshot in time, is over 10% right now, 3 times the amount we expect. Now, obviously, we're dealing mostly with January data, and we had some storms in February that will slow things down, but the economy is growing faster. It would take a lot for it to have a bad quarter right now, and that's why you're seeing the Fed officials push back, because their goal is to get more people employed, and they don't think that the market is right about inflation. Here's what Tom Barkin told me yesterday.
As I'm speaking to businesses in our district, I'm not hearing a sense of overwhelming desire or intent to be escalating prices beyond normal levels. So I think we will see some pressure, but I do still expect the medium and long term for it to be moderated.
That's why they don't want to ratify the market's belief that the inflation rate is going to rise and that yields need to rise. They don't want anybody thinking that they're going to make any monetary policy moves. Although, John, they may have to make one. Here's a problem that's developed in the last few days. While we've seen the long end start to rise, the short end, you can see overnight repo there starting to trade negative on some days. That's because there's a shortage of bills as Treasury runs down their cash balance. Some people are suggesting now, and this is a growing chorus, that maybe we need to see an Operation Twist. The Fed sells bills into the market and buys more at the longer end.
Mark Urbana, Bank of America, raising that one, Mike. I think we're catching up with him a little bit later on Bloomberg TV. Mike, thank you. Let's bring in the team. Steve Forbes, Barry Bannister, Alpha Omega's Peter Cecchini. Mr. Bannister, great to catch up with you, sir. This economy is looking pretty decent. I'm decent as well. So let's start with this economy and whether what's good for this economy is good for this market.
I believe your earlier speaker said it best. You know, why are we pouring 10% of GDP of stimulus into an economy with about a 3 or 4% output gap? We're going to come roaring out of the gate. This is clearly backdoor universal basic income through front door MMT Fed monetization of deficits. So that's the path that we've chosen, and we'll see how it goes.
And yet, Barry, you think there's some major headwinds north of 3,900 on the S&P. How so, Barry?
Well, this year we're going to likely see about a 20 to 22% drop in the trailing PE of the S&P 500. At the same time, earnings grow by a similar amount. We are below the street this year. We don't have quite as big a liftoff in the second half estimates as the other analysts. As a consequence, the market would consolidate recent gains and flatten out. Remember last summer, we went sideways for a while, and so we've been forecasting after we hit our target a flattening out of the market here.
Pete, I'm sure that resonates with you, sir.
Yeah, it does. You know, look, an important piece of this is the idea is that even if we get a little bit more of a lift in long yields, and Mike's point is well taken on twist or maturity extension, you know, that places another 50 basis points, call it 2%, really has an outsized effect on PEs. And I'm in the same camp as Barry. That is to say, you know, earnings were challenged in 2019. Fourth quarter earnings were stimulus driven largely. It's why they came out better than expected. And that organic growth that we need for earnings alongside higher capital costs coming through the rates component, I think is going to challenge equities, which I think have been overvalued for quite some time.
Where in this market do you think we're stretched right now? Where in equities, Pete?
Well, look, tech has been stretched for some time, and we understand why. It was a convenient narrative to buy. Given my view of inflation, I do think cyclicals on a relative basis, commodity names in particular, probably do have some room to run. But overall, I think equity valuations are definitely long in the tooth.
Barry, I know you've given that some thought as well on the commodity side of things. Whenever we get a rally, it's a new super cycle. Can you draw a distinction between the two things?
Yeah, the the super cycles in commodities tend to last about 10 years. We had one in the 40s, the 70s, and the O's. I don't think that's what we're going into right now. I think we're going into a cyclical rally that can last for 2, 3, 4 years. And it reminds me of those in the past. We had a couple in the 1990s, if you recall. And as we have a commodity rally, some of these beaten down value stocks, value relative to growth, fell 50% in 4 years through September of 2020. Those mean reversion of the value stocks is probably the trade that you're seeing right now. And small cap and international fit the same mold.
Do you need China to deliver much better rates of growth to get anything near like what we could describe as a super cycle, Barry?
Keep in mind that the main question is going to be the dollar. The dollar's great rate of growth, this is the growth rate of the dollar index, the momentum of it, has already peaked. So while it's not an outright bear call on the dollar, although Washington's doing everything they can to undermine the dollar, which strengthens the Chinese yuan over time, and they maybe replace this as a reserve currency, which is a real risk to living standards in the United States, that over time the dollar should weaken. Now, we could have a counter-trend rally here, but the combined fiscal and current account deficits should weigh on the dollar over time, as well as this fiscal recklessness that we're pursuing in the D.C. corridor.
Pete, I know that's where there's a bit of daylight between the both of you there. On the US dollar, why are you less constructive, or in fact more constructive, on a US dollar going forward?
Yeah, I mean, obviously, by definition, currency crosses are just that. They're a relative value assessment. And the dollar undergoes persistent shortages globally. It's one of the reasons why, whenever there's any stress on the global economy, most other countries hit the dollar swap lines that the great financial crisis put in place. And I think until that structural shortage abates, especially relative to the euro and the yen, the dollar will do just fine. I think Barry's concern about the yuan is well-founded. I think that is one of the biggest threats that we have over the next 5, 10, 15 years, and certainly is something that I know our officials are concerned about as well.
Hey, Pete, good to catch up. Peter Cicchini there of Alpha Omega. Barry Bannister will be sticking with us, I'm pleased to say. Coming up, the analyst action you need to know. That'll be next in our morning calls. And later, Zoom, topping earnings estimates, signalling growth in a post-pandemic environment. That conversation's still ahead with Stifel's Barry Bannister and JP Morgan's Jack Manley. From New York City this morning, good morning. Equities recovering. The S&P 500 unchanged this Tuesday morning. More still to come. This is Bloomberg. coming off the back of the biggest one-day pop on the S&P 500 going back to June 2020. The follow-through this morning, we turned positive in the last 10 minutes. The S&P 500 back through 3,900 and up 2 points on a session, up almost 0.04%, a muted gain this Tuesday morning. Let's get you some morning calls, a look at some of the analyst recommendations on Wall Street this morning. We begin first up with Citi upgrading TripAdvisor to a buy with a $62 price target. The analyst estimating that its new subscription service could create an additional $1 billion of revenue. That stock is up by 4.28% in the pre-market. Your second call comes from the team at Wells Fargo upgrading Dowing to overweight with a $77 price target. The analyst highlighting its attractive exposure to commodity chemicals during the recovery. That stock up there by around about 0.8% to $62 and about 6 cents in early trading. And your third and final call, it comes from Piper Sandler upgrading Zoom to overweight after earnings topped expectations. Guidance to the analyst expecting its phone and meeting products to drive future growth. We're up there by 7.62% to 440.87 in early trading. Much more on that. Abby will run you through the movers at the opening bout. Coming up, much more on Zoom and the post-pandemic market environment. That conversation still ahead with Stifel's Barry Bannister and JP Morgan's Jack Manley. Looking forward to that this Tuesday. We recover in the equity market after a blowout day yesterday. The S&P 500 higher. We add just a little bit of weight to it this morning. This is Bloomberg.